Hi there, QuickBooks experts. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. In this video, we're going to cover Chapter 6, Recording, Investing, and Financing Activities from QuickBooks Online for Accounting 2026. Upon completion of this chapter, you should be able to record the acquisition of a fixed asset. So in plain terms, that means recording the purchase of a fixed asset, record the acquisition of a long-term investment, record the sale of common stock. So as we know, when we deal with corporations, common stock is essentially the investments that are made by the owners, often referred to as the shareholders. We'll record the payment of a dividend. So this is essentially where the owners, they receive a portion of the profits, the retained earnings that a corporation makes. We'll record a long-term borrowing, long-term debt, record payment on long-term borrowing, long-term debt, and we'll also record the acquisition of a fixed asset by taking on new debt. In Chapter 5, we had the opportunity to add new vendors, purchase orders, bills, credit card charges, and checks to the Wild Water Sports Company. And then we also paid some bills. In this chapter, we're going to add some investing and financing activities like the acquisition of the fixed asset and the long-term investment, as well as the sale of stocks, payments or dividends, acquiring and paying long-term debt. So just a quick recap, our operating activities, this is essentially the normal course of operations for the business. So anything that they do to earn revenue, how they provide services or sell products to customers, and any expenses that are incurred within the normal operation. So like they say, in order to make money, you have to spend money. So all business activities are broken out into these three activities. The first is operating, and again, that's like the normal course of operations. And then we have investing, and this is where companies purchase long-term assets. And as we know, assets are anything of value that a business owns that is going to provide it with a future benefit. So in this case, we are going to purchase things like investments, purchase long-term investments and things of that nature. So it could be equipment, it could be land, it could be building. These are all examples of investing activities, and that also applies when we sell these long-term assets. Financing activities, on the other hand, this is essentially how the business finances its operations. So when we're dealing with a corporation in particular, they finance their operations by issuing common stock. This is where investors, individuals, and other businesses, they invest, they claim ownership in a corporation. And then we have bonds. Bonds, that is essentially where the company is borrowing money from individuals and other corporations. So just want to ensure that you understand the different types of activities that a business can engage in. Again, we have operating, investing, and financing. So we're going to jump right in. So the first thing we always want to do is to verify the accuracy of the Wild Water Sports. So it says sign in. I'm already signed in. And the first thing we use is this trial balance report. So here for the trial balance, we're going to start off with January 1st, 2027. And the end date is going to be January 31st, 2027. So I already have it set. So the key thing that I typically always do is I double check to see what are my total debits and my total credits. So just going to make this a little smaller. So here we see our total debits and credits are $634,565. Perfect. So everything seems to tie. But again, with the trial balance, just because rather the balance is tied, it does not necessarily mean that everything is correct. So we'll check the account balances one by one. So checking of 22,345. Accounts receivable, 120,770. Inventory, 223,350. So you basically go through all of the accounts and make sure that everything ties. And as of right now, I'm quickly skimming through, and it seems as though everything lines up. So once you double check to make sure that everything ties, then you are ready to keep working. So in this section, we're going to record the acquisition of fixed assets. So again, acquisition is just a synonym. It's another way rather to say purchase. Fixed assets are long-term tangible property that a firm owns and uses in the production of its income. So one key thing to keep in mind, tangible, that essentially means an item. And as we're specifically dealing with tangible assets, Tangible means that you can perceive it with your five senses. So you can see it, you can touch it. So a building we can see, we can touch. Equipment we can see, touch, computer, etc. Then when we have our intangible assets, these are things that have value. So that would be like the goodwill, the reputation of a company. We can't necessarily see it, we can't see it or touch it. However, it has value. So our tangible assets, the ones that we can physically see and touch, those are allocated using depreciation. And for our intangible assets, those are depreciated. Well, I don't want to say depreciated. Those are the costs, rather, are allocated using amortization, right? So that's the difference between tangible and intangible. So again, fixed assets, they're long-term tangible property that the firm owns, and they basically use them in the production of income. So if we think about a company that let's say they make clothes, they have a piece of equipment or a sewing machine, that sewing machine is ultimately helping to generate revenue. And these fixed assets, they're not expected to be consumed or converted into cash any sooner than at least 1 year's time. So that's the difference between our current and our long-term assets. Current assets, they're going to be used up within a year or less. And our long-term assets, they're used for 1 year or more. Normally, a fixed asset's cost is going to be depreciated over time as a means of allocating its cost over its useful life. So in accounting, depreciation does not necessarily just reflect the loss of value, but depreciation is essentially allocating the cost over its useful life. So let's say we have an equipment and we pay $10,000 for the equipment and we anticipate that it's going to last in the business for 5 years. What we do is we allocate that $10,000 that was spent in year one over the next 5 years. So that's essentially what depreciation is, because long after the 5 years, you could probably still use that equipment. All right. So the depreciation is recorded to a depreciation expense account and added to an accumulated depreciation contra asset account. And that accumulated depreciation is simply just an account that is used to track the depreciation that's been taken. And the reason why it says contra asset is because assets have a normal debit balance, but accumulated depreciation account has the opposite, contrary to the normal. So accumulated depreciation has a normal credit balance. And this process is going to be explained in later chapters, especially the one where we discuss adjusting entries. So in order to add an asset, we're going to use the check task assigned by clicking the plus new or plus create in our case. Alternatively, you can purchase a new fixed asset using a credit card or take on new debt. The Wildwater Sports Company has a fixed asset account for equipment, and we're going to use this to record the purchase of a computer. If we were to purchase some other type of fixed asset, furniture, for example, we would need to create 2 additional sub-accounts to the furnitures and fixtures. So we would first create the original cost, and then we would create the accumulated depreciation account. So we're continuing from above. We want to open our navigation bar. But again, this is the new version. Just going to quickly show you. This is the new version of QuickBooks. So if you are not seeing this version of QuickBooks when you log in, if you go to your settings and you select switch back to the previous version. And if when you log into QuickBooks, you are seeing this version, you are using the older version of QuickBooks. Considering they are going to eventually phase out this version of QuickBooks Online, I would strongly suggest that if you see this version of QuickBooks Online when you log in, that you select the gear icon, the 3 dots. Well, it shows as a 3 dot, right? 3 dots right now, but I'll show you what it typically looks like. All right, so this is what it typically looks like. But because of the space, that's why we see the 3 dots. All right, so you click on it and then you select switch, try a new version of QuickBooks. So I strongly suggest switching the version of QuickBooks that you are currently using. So that way, not just that you can follow along with the video, but also so that way you familiarize yourself with the most updated version of QuickBooks Online. All right, so the first thing we're gonna do, we're gonna click plus new, and what you're gonna see is that now it's plus create, basically the same thing. And then we are going to select check, which is under vendors. And then we are going to select add new. And then we're going to be adding Best Buy. as the name of the company. Save. The date is January 20th, 2027. Check number 1003 is already there. So we're going to select original cost under the equipment in the category column. So this is the category column. This is the product or service. So we use the category column when what we are purchasing or paying for does not impact inventory. If it does impact inventory, that is where we're going to use product service. So in this case, we select original cost, which is the sub account of equipment. And then we type $8,000 in the amount. So this is what it should look like, which it does. We have our payee, the mailing address, the bank account, payment date, check number. The category is equipment, original cost. And here we have our amount of $8,000. So we select save and new. So here you see we have save and close. We select this downward facing arrow. We select save and new. And then from there, we're going to be adding a new payee. We're going to add office max. This is a vendor. We select save. And then now in this case, we're going to add new. So we are going to add new. We're going to select fixed assets as the account type, and then fixed asset furniture in the detail. And then we're going to type in original cost. And then we're going to make this a sub account of furniture and fixtures. And this is going to be as 01/20/2027. All right, so we added that, and now we select save. And then we're going to type in $10,000. Select tab. Then we want to make sure everything ties. So we have office bank checking. We have the check number, the date, the original cost account. It should be under. All right, so that seems to be messed up. So here's what we're going to do. So I'm going to duplicate my tab so that way I can update it. And this is, a good checkpoint, because in the event that, let's say you are working through QuickBooks and you make a mistake, a lot of times people think that they need to start all over. No, you just need to find the error and fix the error. You do not need to start from scratch. So in my case, I realized, wait, hold on. The original cost is not a sub account of furnitures and fixtures. So I'm going to find it. You can either scroll down or you can type it in. So original cost. So I select edit, and it should be, it should be furnitures and fixtures. So save. All right, and let me check my furnitures. Okay, perfect. All right, so the first thing that I'm going to do, original cost, perfect. Okay, there we go. So it was saved. All right, so that was just, some good insight for you to know how to, save one if you needed to. So this is save and new, but I want save and close. So I select the downward arrow, select save and close. And then we've recorded the purchase of 2 new fixed assets. So we recorded a check. And then from there, we essentially just listed the asset. So now we move on to long-term investments. The acquisition of a long-term investment is another type of investing activity. In general, a long-term investment is going to be the purchase of a financial instrument. So this could be a bond. This is essentially where you are lending money to a corporation or the government, and they are promising that they're going to pay you back the principal amount as well as interest. And then we have common stock. This is essentially where you are buying into a company. So you get common stock, and that represents your ownership in a company. And then we have preferred stock, which is similar to common stock, but you have preference, right? So I typically explain it like, the common folk. So with that being said, you have certain rights, but in the event, let's say the business liquidates, they go bankrupt, the money, when they liquidate, and liquidate simply means to turn the assets into cash. So the first thing they're going to do is pay out the vendors, or the creditors rather, anyone that they owe money to. And then whatever's left over, they're first going to pay the preferred stock shareholders. They have preference. And then the common folk, they basically going to get what's left over. All right. So that's the difference with common stock, preferred stock. Again, they both represent ownership in a company, but preferred stock shareholders, they have preference. So with that being said, with these long-term investments, these financial instruments, they mature in more than 1 year. So we're going to continue where we left off. We're going to select the plus new or plus create. We're going to select check. And then we're going to add new from the payee box. And we're going to add Scott trade. Then we select save. And the date is going to be January 21st, 2027. Check number 1005 is already there. And then from there, we're going to select add new and add category. And again, when we are dealing with items that do not impact inventory, we use category. And when the items impact inventory, that's where we use the item details down below. So we select add new. And then we're going to select other assets from the account type. And then it's going to be other long-term assets for the detail type. And then we're going to type investments as the account name, and we are going to select save. And then from there, we type $3,000 in the amount column, select tab. And then as we see, we are good to go. So we select save and close, and we just recorded the purchase of a long-term investment. So now we move on to some financing transactions. So in a corporation, as mentioned, the sale of common stock and the payment of cash dividends to shareholder. These are two common financing activities. Common stock is a stockholder's equity account. And the key thing is that this account tracks all of the investments by the owners. And this can represent cash or property, any other form of property that the investments, or the shareholders rather, the investments they make into the company. And then we have dividends. These represent a distribution of earnings to the shareholders, and they're accounted for as a reduction in the retained earnings. So whenever shareholders receive dividends from a corporation, it's not being paid out of their initial investment. It's being paid out of the net profit that the company generates over the years. And we track that in a special account called retained earnings, because as it relates to our income statement accounts, our revenue and expenses, those are our temporary accounts. They are reset every period. And simply stated, we transfer the balance, whether it is a net income or net loss, we transfer it to our permanent balance sheet account, which is retained earnings. So sometimes the verbiage can be a little confusing when we're dealing with a corporation, but it's essentially the same thing. The same logic when you are dealing with a sole proprietorship, even with a partnership, even though it's a bit more nuanced because you're tracking things separately. But for the most part, even though there's different terminology, the fundamentals ultimately remain the same. If the company has net income, that has a positive effect for the owners. And if there's a net loss, it has a negative effect for the shareholders. All right, so here we see dividends. They're going to be, both of them are cash activities. In the sale of stock, they result in a cash receipt, and we're going to account for it using a bank deposit, whereas the payment of a cash dividend results in a cash payment. One previous payment from a customer, Refugio, that appears when we're going to attempt to record a bank deposit from the issuance of stock. These payments, they've already been received, but they're not yet recorded. So the instructions say for us to ignore them for now. In order to simplify the transaction, we're going to assume that the common stock is no par common stock. Thus, no additional paid-in capital exists, and we're going to assume that the dividend declaration record and payment dates are all the same. So this essentially ties into maybe like accounting 2 or intermediate accounting 1 or 2. Simply stated, common stock, let's say the value of the common stock is $8. You could sell it for $6 or you can sell it for $10. So in such case, where we have common stock with a par, if let's say the stock is worth $8 and they pay $10, the shareholders paid an extra $2 per share. So therefore, there's additional paid in capital. As it relates to the dividend declaration date, the corporation, that is the date that they make the decision, hey, we are going to pay our shareholders $1,000. The date of record, that is basically where they are determining who is going to receive a portion of this $1,000. There's no formal journal entry that's required. And then lastly, the payment date, that is where the corporation is actually fulfilling their obligation and they are paying. So typically in the real world, it's not always the same date, but to just make things a little simple, that's why they choose to go that route. So in a sole proprietorship, there's no common stock or dividends. Instead, we have the owner's investments in the owner withdrawals account. Owner investments are recorded by entering a bank deposit to the owner's equity account, and owner's withdrawals are recorded by entering a check to the owner's equity account. But again, Wild Water Sports Company, this is a corporation. So that is why ultimately we are using common stock and we're using dividends. So we're going to continue right where we left off. We're going to select plus create plus new. Now we're going to select bank deposit under other. We're going to select add new from the add funds deposit section. We're going to type WV Investments as the vendor. And then we are going to select save. The date is January 21st, so that's already there. The account is going to be common stock. The method payment is going to be check. And then there's going to be $56,000. Or sorry, 56,000 or 50, yeah, well, 3 zeros. So 56,000 is the reference number. And then the amount is going to be 10,000. All right, so this is what it should look like. We have the checking account. We have the date. Again, we're not, focusing on Refugio. We have WB Investments. The account is common stock. The payment method is check. The reference number is 56,000 and the amount is 10,000. So we select save and close. And then we select plus new. We select check under vendors. And then now we are paying our shareholders. And the date is going to be January 22nd, 2027. We already have the check number pre-populated. And in the categories section, we're going to type in retained earnings. And again, retained earnings, this represents the net income and net losses minus any dividends paid that's been tracked since the inception of the company. And we're going to type in $1,500. And we select tab. And then we select save and close. So now we're moving on to long-term debt. The borrowing of funds on a long-term basis and the repayment of debt. There are two additional financing activities. Both of these are cash activities in that the borrowing of funds results in a cash receipt. We're going to account for it as a bank payment, whereas the payment of debt is going to result in a cash payment. There's one previous payment from a customer that's going to appear when we decide to record the bank deposit, but again, we're basically going to ignore them. So this company decided to refinance their existing long-term business loan with Chase Bank. So we're going to record the receipt of cash from the new loan and we're going to pay off the old long-term debt with interest. Because as you know, if you borrow $1,000 from the bank, you're probably going to end up paying back like $10,000 right? In interest. Or if we talk about student loans, don't even get me started with that one. But anyhow, I digress, okay? All right, so in order to record the receipt of funds from borrowing and paying the long-term debt, we're going to do the following. We're already in QuickBooks, so we're continuing where we left off. We select plus new. We're going to select bank deposit under other. Received from is going to be Chase Bank. We're going to select checking from the account box. The date is going to be January 23rd. And then we're going to select long-term business loans. All right, whoops, sorry about that. All right, so let's start back. So we have Chase Bank. Checking is already selected here. All right, so the verbiage was a little confusing. So checking is here. We already have the date. And then long-term business loans is what is going to be input here. And then we're going to select check for the payment method. And we're going to type in 150,000. So we want to double check, make sure everything ties up. So we have the account checking, the date. We have Chase Bank long-term business loans. Payment method is a check and the amount is 150,000. We select save and close. Now we select plus new again. We select check under vendors. We select Chase as our payee. We're going to select checking from the bank account. It is already selected. The date is January 23rd, 2027. The check number is already there. And our category is going to be long-term business loans. And then we're going to type in $50,000 as the amount of payment for the first line. And then for line 2, we're going to type in interest paid. That amount is $2,500. And then from there, we're going to select save and close. So we completed the process for recording and investing activity. So we recorded the purchase of a fixed asset. We also recorded a financing activity, borrowing on a long-term basis. And both of these transactions were recorded by affecting the checking account, the cash. Occasionally, sometimes a company, they acquire a fixed asset by issuing long-term debt. So for example, if you purchase equipment in exchange for a long-term business loan, this cannot be recorded using the checking account. Why? Because there was no exchange of money. So instead, in those cases, we use a journal entry process to record the fixed asset acquisition as well as the long-term debt borrowing. So we're going to select plus new, and we're going to select journal entry under other. The date is going to be January 25th, 2027. We have journal entry number 5. And we're going to select the equipment original cost. So we have our equipment original cost. And we're going to type $5,000 in the debit account. So the reason why we are debiting it is anytime we want to show an increase in our asset accounts, we must debit it based on the fundamental bookkeeping principles. So by debiting this account, we are showing an increase to our assets. And then for line 2, we are going to credit our long-term business loans for the $5,000 because anytime we want to show an increase to a liability account, we are required to credit it. So we click save and close. So the work we completed in this chapter, it obviously had an impact on the company's trial balance. As in previous chapters, we created a trial balance report after entering all of the business events described in this chapter. And what we'll do is investigate any differences. So we see originally we started off with the trial balance at $634,565. However, after all of the transactions, now we see that our total trial balance should be, or debits and credits rather, so let me update it, should be $748,065. So again, you always want to verify the debits and credits first, and then you go through each account one by one to see and make sure that all of the account balances are correct. So I'm skimming through to make sure that everything is correct, looking at them one by one. All right, perfect. Everything ties. So in order to create the trial balance, I already went to the trial balance. You'll go to reports. I already saved my custom report, my trial balance. So I click on it and I essentially changed the date to the 31st. We click run report. And then from there, because everything tied, we are pretty much good to go. In the event that there are any differences, you cannot move on to the next chapter. That means that something is incorrect and something needs to be fixed. So please keep that in mind. So now this is the end note. We made it to the end of chapter 6. So in this chapter, we recorded investing activities, the acquisition of fixed assets and of long-term investments, the sale of common stocks, the payment of a dividend, the borrowing and paying of long-term debt, and the acquisition of fixed assets by taking on new debt. In the next chapter, we're going to work with payroll. But again, keep in mind, Intuit, they've changed the default inventory asset account to inventory instead of inventory asset. So as you work through, sometimes, certain things might look a little different. But ultimately, once you understand the basic principles of accounting, the basic bookkeeping principles, things are easy. So that brings us to the end of chapter 6, investing for QuickBooks Online 20.